Deborah's already here. Skip it from a lot of it. See, that would be the system. Not working. There's not anything. Leave that up. Is the screen changing when I dude, I hadn't seen you in like a month. All right, everybody, we're going to get going here. You got Ben. When John Glenn stops, we'll start. Thanks everybody for coming out. We apologize for the temperature. We didn't make the sun, but we also didn't break the air conditioning. It's very warm in here. Because of that, I'm happy to announce we've condensed the presentation. It's normally like 80 slides. We're down to 73 this quarter, so we're going to fly through these. Thanks for coming. We are going to have time for Q&A at the end. I would encourage you, if you have questions, maybe just kind of sit tight and holler at us at the end. That way we can do that. We do have people that are on the Zoom, so they may have questions that pop in as well. That way we can make sure we're not stepping on each other's toes too much. We appreciate y'all coming. They'll come around, take drink orders throughout the presentation. Not a whole lot of good news, so you might want to have an extra drink. With that, I'm going to turn it over to Ben, and he's going to take us through what he called Bad Moon Rising. I suggested Cocktails and Calamity, but alas, Ben's in charge here. So, Ben, take it away.
Yeah, so here's the disclosure. You guys have a copy of that if you really want to read it, but I'd recommend just flying through that. I think the big thing is that we're aware of a lot of what's going on in the economy. I think it's something that we all see. One thing that we want to keep in context as we go through this presentation is that we're still long-term bullish on America. Warren Buffett said last year that it's always a bad bet to bet against America, and we still think that's the case. We still have really good rule of law. We have a very strong financial system and financial backbone. And we have an innovative population, and that doesn't change. But the economy does go through cycles, and we're not at a great point of the cycle. So that's what we're going to be talking about today. What's interesting is that just 6 months ago in January 2022, there was a massively different view of what was going on in the economy. Jamie Dimon, who has his finger on the pulse pretty well for the U.S. economy, he is the CEO of JP Morgan. He said that businesses were in good shape, consumers were in pretty good shape, and he felt pretty good about the economy. But then fast forward 6 months, and this is what he was saying just last month. And he was talking about a hurricane coming in for this economy. Zuckerberg's been talking about people self-selecting out of Facebook who can't handle the pressure. And then everyone knows Elon Musk has been in the news for a variety of reasons. We do our own survey of local businesses. And what I draw your attention to here is the green line. This is the estimate of these businesses in terms of their own optimism of where their own company is going over the next 12 months. And we've seen that decrease significantly even since April. We've seen the optimism index kind of go from 9 to 6 over that period of time. And so we've definitely seen a ratcheted down in expectations and optimism from leaders in our own community as well as over the United States as well. First section of this presentation is going to talk about where we are and how we see this cycle progressing. Again, as part of this economic map, we're going to be talking about inflation, and we're going to be talking about recession. And we do think that we're transitioning potentially from a period of stagflation to a period of recession, and something that'll feel worse. Pepsi today reported earnings. They actually saw volume for their North American beverages business as well as Frito-Lay. Volume was down 2%, but they were still talking about revenue growing 14% because prices were up 16% from Pepsi. So that was taken by Wall Street as a solid report, but their underlying volume was down. And so we're going to be talking about the differences between those two. We're going to be talking about risks to that outlook, both upside and downside. And then we're going to be talking a little bit about where we see the market going from here. First is wage growth has actually performed pretty well. Wage growth is, in fact, as strong as it's really ever been since this survey has been going on since the 1990s. It's about 6.1% today. The problem is, as we all know, that's getting eaten away by inflation. So today, I think the AAA average is 466, which is down a little bit from when we did this chart, but it's still 50% higher than where it was at the beginning of the year and where it was this time last year. And as a result, average hourly earnings in real dollar terms are falling. They're down about 3% on a year-over-year basis. And the problem is every month that this continues, you see declines in purchasing power, and it just hurts that extra bit more. If you zoom in and just look at the last 4 years, you can see that we're actually falling at an accelerating rate, which means that each month that goes by, people feel even worse about their economic situation and have less disposable income. As a result, when you make less money, you can buy less stuff and you can save less money as well. Monthly savings as a percent of disposable income are as low now as they've been since the global financial crisis. And on this chart, you can see that a little bit more clearly. That's not such great news, but what we really don't like is the shape of that decline. Not only is monthly savings as a percentage of disposable income low, we're not saving a lot, but we're saving less and less every month. And that's what concerns us. If you look at checking account balances, the charts are a little bit difficult to discern. The left-hand side is the percentage above 2019 levels that checking account balances are up. And you can see that that's beginning to decline. But the right chart, what I draw your attention to is each of the dotted lines is a round of stimulus. After the first round of stimulus, checking account balances went up and stayed relatively elevated. After the second round of stimulus, checking account balances went up, stayed relatively elevated. After the third round of stimulus, checking account balances went up, but very quickly thereafter began to decline. And so what's important to take away on that is that we're eating into those savings. And so when people look at their savings accounts and are eating into those every month, that doesn't feel so good to them. And that's when you start to pull back on spending, and you might start to use your credit card a little bit more. In fact, here on the left-hand side, you can see that you need more months of savings now to pay off your credit card than, again, since 2013. And again, that's beginning to accelerate as you see it on the chart on the right. So not only are we saving less and utilizing credit more, but that's accelerating. Now, right now, credit card delinquencies are still relatively low. They're low historically. They're 0.79%. In the United States, normally you'd be at a 1.5%. So we're low historically, but the speed at which that's changing, the speed at which people are taking out more credit, the speed at which people are saving less is a cause for concern. I think the chart on the left really sums this up quite well. People feel relatively good about the current situation. That's the blue line. But in terms of expectations, people do not feel well at all. The chart on the right is the University of Michigan Sentiment Index. That goes all the way back to the 1960s. This is as bad as people have ever felt, because they're looking at their balances and they're seeing them go down. They're seeing their monthly budget go up, and they're seeing themselves in a bit of a deficit. So people are changing their buying habits. What's interesting to note here is I think that with gasoline prices, a lot of people think that people are just buying a ton of gasoline right now. That's not the case. In fact, gasoline demand is lower now than it was this time last year, which Economics 101 says, okay, that actually makes sense. Prices go up, demand falls. But I think it's actually interesting to point out that gasoline demand is actually down year over year. And we're also seeing a shift in consumer buying habits and elasticities on the consumption side. People are spending less on discretionary products like at Bed Bath & Beyond, and they're spending more on essential products. After the pandemic, people spent a lot on discretionary products. This is a long-term trend that goes back to the 1990s. Clothing is not supposed to increase 25% on a year-over-year basis. That's just not what it's done historically, and that's not what we should continue to expect. And so what we would expect here is as people shift away from discretionary spending to essentials, you'll see the sales at clothing stores start to decline. The same is true in department stores. People have been shopping less at department stores for the last 30 years. We don't think the period over the last 18 months marks a significant change to that. We would expect a bit of a decline to that trend line as department store sales normalize. And what are people buying instead? They're forced to buy more gas, or the same amount of gas at higher prices. And this is why you see this well above trend. And this is what's driving a lot of the change in consumption patterns in the US.
So we're certainly seeing changes in behavior, and we're probably going to continue to see those. As you think of a transition from stagflation to recession, we're going to continue to see changed behaviors, but we're also still kind of shaking off some of the pandemic era trends that we saw. This is an interesting chart that tracks Google search trends for the term vacation, as well as Google flight searches. There was a sizable gap where people were still looking for ways to get away during the pandemic, but they were not necessarily looking for an opportunity to hop on an airplane. We've seen that gap close pretty significantly, and that lends itself to the combination of gas that making people think, hey, maybe I won't hop in the car and do that. But we're seeing people are buying airline tickets at record high prices. So the orangish colored line, some people say it's brown, I don't see color. That line, you can see there is the number of transactions. And you see it absolutely plummet in March of 2020. The greener line, I think it's green, is the actual price paid on average for fares. We actually dipped negative in March of 2020 because there were so many refunds and rebates being given on people that wanted to travel. But you can see that we are essentially, yes, high on transaction volume, but really back where we were before the pandemic. And we are very, very high on prices. And we're starting, because of that price, to see the transaction volume start to decline a little bit. What we're learning from that is, as you might expect, we talked about the elasticity of gasoline prices, where there's a certain finite amount of demand that will always exist regardless of what the gas price is. But there is a degree to which people think more consciously about how many miles they're putting on their car. The same is true as it relates to the airline industry. As prices really ramped up, people kind of peaked out in their decision making in January of this year, in which they said, it doesn't matter what it costs, I will still fly. People are now making decisions based on the trend data that suggests it's just too expensive to fly. I'm either going to travel through alternative means or I'm not going to travel at all. So travel was one of the first things that we saw really cut off during the pandemic. It's one of the first things we're starting to see really react to the combination of overpricing as a byproduct of inflation, as well as some recessionary concerns. Inflation is continuing to push consumer budgets to where people have to focus on what they really want to spend money on, and it's taking up a larger and larger portion of their disposable income. You can see those elevated prices. This reflects retail trade and food services, excluding gas. You can see how high we are on an elevated level, and you can see where people are spending more money. That long tower right there in the middle is gas stations. Right now, all of these things are positive and they're above trend, but those figures that are smaller on this table are the figures that we expect to be the first to fall, where people start saying, you know what, we're going to spend a little bit less at department stores and clothing retailers, has been mentioned. And also, as this chart suggests, we're going to spend a whole lot less on food services. During the pandemic, a lot of people got really comfortable paying an extra 20% to have their taqueria tsunami delivered to their house. And by people, I mean my wife. People got very used to that. They're not going to keep doing that. We're not going to keep doing that. She's not going to keep doing that. I haven't told her yet. If any of you guys want to do that, you're welcome to. But there are going to be entire cross sections of excess in the economy in which people were spending more money than they quote unquote had to get something that they wanted. And so this is a survey that's forward looking of 1,000 respondents. Bank of America does this survey, and it talks about how much they expect to spend in the following 3 months. So it is predictive. But where you see those red numbers, and food delivery is the bottom row, you can see that people are consistently saying, you know what, I'm going to spend less here, I'm going to spend less here, I'm going to spend less here. What's very interesting is leisure and travel we're dipping back and forth between spending less, spending a little more, spending less, spending a little more, spending less. I would expect that if we looked at this in 3 months, we would see a solid block of red in which people are saying we're going to spend less. Consumers are having to cut back on travel. They're having to cut back on restaurant spending. And these charts both illustrate that pretty significantly, both for lower income and upper income. We very much anticipate a swing from spending what they're used to spending less. There's no better example of this than day-to-day decisions. We very much expect that kind of that middle tier of people that are doing everyday shopping will be transitioning from shopping potentially at Target, a slightly higher end store, to Walmart. Budgets are increasing very, very quickly as a byproduct of inflation costs. Yes, you're getting more money, wages have performed well, but you're not getting enough to offset inflation. You're probably going to see a large portion of the economy make some hard decisions about maybe I don't shop at my preferred destination, I go somewhere else. Savings are falling rapidly. We've talked with a number of clients about this lately. The reason we are not in a deeper recession right now, in my opinion, is the fact that we were at all-time highs in terms of consumer and household savings at the end of 2020. When you think back on 2020, you will probably think about COVID, the pandemic, the masks, the social distancing, all of that stuff. Lost in all of that is people saved more money in 2020 than they really ever have. They built up those balance sheets and we've been drawing down on them. As you draw down on them, you've got choices to make. Are you going to take on personal debt, or are you going to change your shopping and consuming behaviors? And we really expect that to be at the forefront. Probably next quarter, we'll see even more data of that.
Yeah, I think Target's a great case study in what's been going on here. Target on May 15th came out with their first fiscal quarter earnings report. They reiterated revenue guidance for the year. So they see the same amount of sales, but where people are shopping has changed. People are shopping, they're not shopping those high margin goods, the TVs, the home goods. Instead, they're shopping on the low margin products, the essentials, the food. And so as a result, they took down margin guidance from 8% to 6%. That might not sound like a lot, 2%, but it's 25% of the company's profit. And so you saw a massive haircut in the earnings profile of Target. And at the time, the management sounded like, okay, they're taking the hit now, but they're taking the hit early and they'll be able to kind of move forward now with this new guidance. Well, that wasn't the case. Just a few weeks later, they revised guidance down again on the margin side, not on the revenue side, reiterated revenue, revised guidance down on margin. They're announcing a lot more markdowns. They're trying to get rid of a lot of patio furniture. And so this is how inflation is impacting businesses today. The concern is, as we look forward, what happens when and if Target has to reduce that revenue guidance as well. So this is a case study in how inflation is actually impacting the bottom lines of businesses out there. Orders are slowing. Again, the backlogs are high, but just as we saw with checking account balances that are elevated but coming down, backlogs are elevated, but orders are beginning to slow just a bit. Whether you're looking at the apparel space, if you're looking at the retail trade space, even in the chemical product space. So that is making CEOs a bit more conservative. They're a little bit more nervous. And the added piece of this is the stock market decline. Because when you see your stock going down as well, it's less easy to raise outside capital. And we're beginning to see that. Follow-on offerings, which is a company that is already publicly traded, that comes to the market to raise more capital. That's that first chart. That's down substantially from prior years. Initial public offerings, companies that are coming public and raising capital from the equity markets, that's essentially nil compared to prior years. And SPAC transactions, which we've talked a lot about over the last 2 years, that's completely fallen off the map as well relative to 2020 and 2021. So the equity markets are not a great source of capital right now. So companies need to look at their own income statements, look at their own balance sheets, and conserve that cash. Here, the last bar only goes through June 30th. So bear that in mind, and you can kind of mentally double that last bar. Left-hand side is the investment grade rated companies. These are the blue chips. These are the companies that are have solid credit ratings and can typically raise outside capital. They're able to raise some debt right now. So they're still able to raise debt. The capital markets are working for them. But the speculative grade companies, the companies that are always kind of on the edge, the JC Penney's that we used to talk about, some of the airlines, some of the more kind of fly-by-night airlines, they're not able to raise debt at very attractive costs right now. So they're not doing it, which means that they have to look at their own house and make sure that they're making the right fiscal decisions and conserving capital internally, because the capital markets are not really there for them and they can't count on them right now. As a result of all this, companies are retrenching. They're cutting down on hiring expectations. That's the top left chart. They're cutting capital expenditure expectations. Note the dates here, and I know it's very difficult to see, but this is a monthly chart. Those data points are monthly. So that big fall off was in June. CEO confidence really fell off a lot in the month of June. And on the bottom, you're seeing revenue expectations decline, profit expectations decline significantly. And as a result of all this, we're beginning to see a rollover in job openings for really the first time since the pandemic. It seems like job openings peaked in March. April and May data have been weaker. And this is a lagging indicator. A lot of these job openings that are out there are stale. A lot of times there have been reports that Facebook, for example, is just not pursuing them. They're leaving the job opening out there. They're leaving the job posting out, but they're not really pursuing that lead. And so we looked at some of the Indeed.com data, which comes out on a more on a quicker basis. And we're starting to see declines in job openings, especially on those type of jobs that are easier to cut and that you don't need as much in a recessionary environment. You don't need as many people in marketing when you expect the consumer to be weak, for instance, and we're starting to see that roll over. We're also just starting to see the early signs of layoffs picking up. This is a 4-week moving average of initial jobless claims. It bottomed at 170,000 in March of 2022. We're now at about 230,000. 230,000 isn't bad by historical standards, but we're seeing this steady increase, and we're starting to see announcements that suggest that this could actually be picking up even faster. Tom has some good data on this website. He found layoffs.fyi.
So I think it's important to highlight why are layoffs ticking up. And there's been a lot of talk about the Federal Reserve raising interest rates this year to combat inflation. And they can't affect the supply chain, right? There are problems with supply chain that's causing costs to rise. But what they can do is affect demand. And the real bleed through on that is layoffs. And so they have a dual mandate. The dual mandate is maximum employment and price stability. And basically, we're at maximum employment. We're at 3.6% unemployment. And Jay Powell, who's the chairman of the Federal Reserve, has essentially said, I am willing to raise rates to the point where we put this economy in the toilet, we put the jobs market in the toilet, because without price stability, i.e. lower inflation, there is no economy. And so that's where we're starting to see this bleed through. And the first place we see that is in startups. These are companies that don't make money. They're trying to grow rapidly. They're getting rounds of funding from venture capitalists, and they're trying to go public. And layoffs.fyi is a site that tracks layoffs in the startup space. And you can see, in the early part of 2020, we saw a ton of layoffs. That space got absolutely crushed. And there basically was a big run up in the market. Everybody felt awesome. Venture capitalism is firing on all cylinders. Interest rates are super low. Now we're seeing increases in interest rates, and we're seeing the first jobs get cut in the startup space. And it's important to note that the far right Q3 2022, that's just the first 12 days. And in fact, if you look at that chart right now, this afternoon, a company called GoPuff, which is a big sort of DoorDash competitor that's looking to go public, $15 billion startup in Philadelphia, laid off 1,500 people today. And so that chart is actually significantly higher as of this afternoon. And a great example of that here in Atlanta is my brother works for a company called OneTrust. They're kind of the crown jewel of the tech startup community in Atlanta. They do internet security, protecting your information on any website you go to. 3 or 4 weeks ago, they laid off 950 people, no warning, 25% of the workforce gone in a day. And that's a company that just recently got a $5 billion round of financing as recently as December 2020. And they were looking to go public. Everyone thought, hey, we're gonna have a meeting to go public. Turned out 25% of those people got fired that day. Sequoia Capital is one of the biggest, baddest venture capital firms, really since 50 years ago. They've got their hands in basically every tech company you've ever heard of. They were the first to ring the alarm bell and basically say, now is the time to prepare for layoffs. If you look at the sort of bluish green line at the bottom, essentially what they've said is, you've got to make the cuts now or have a plan to make the cuts within 30 days, or you're going to basically ramp up into this debt spiral, which is the sort of orangish brown line, which is, you've got to cut costs, you've got to get tight. Otherwise, you're not going to get any additional funding, and you're going to be in a position where your company, which is a unicorn worth billions of dollars, is not public, it's going to go to zero. It's just going to go away. And so that's something we're keeping an eye on as well, as these venture capital firms who are basically saying, this is drying up. We don't have the money, we don't have the cash available, and as interest rates rise, we're not going to be leveraging up to buy, these startups, assuming that they're not in a fiscally responsible position. And this is just more examples. They're starting to bleed into big tech. Tesla, Facebook, Microsoft, all have announced either that they're doing freezes or that they're reducing headcount really as soon as right now. We're seeing a lot of headlines recently that, these big booming tech companies, they don't have the money, or they're not looking to spend the money on new projects. And as interest rates rise, capital expenditures go down, profits go down, revenues go down. And what does that look like? That looks like fewer jobs, less hiring. And the people who are, Tesla's a great example. They're laying off 10% of their salaried workforce, which is the administrators, the accountants. They're looking to ramp up production because that's how they make money. The people building the cars are the people who make money for Tesla. It's not the people in the offices. And I think that's a trend we're going to see over the next 6 to 8 months as the Fed really ramps up the rate hikes.
And ultimately what we see is, if we wanted to distill how we see the economy right now, it's really kind of distilled in this chart. Just kind of going down the center. And we had that inflation that is hitting people in terms of their real dollar earnings, adjusted for inflation. How much money are you bringing in? So what the Federal Reserve is doing is it's raising rates to bring down that inflation, so people feel like they have more money in real dollar terms. But right now, we're seeing those declines in real earnings, and when you have those declines in real earnings, you can spend less. You can buy less stuff. And so this is why we're seeing that transition from discretionary items to essentials, as resulting in lower business profitability. And that results in those job losses, which Tom highlighted. What typically happens in this scenario is the Federal Reserve will then come in to be the buyer of last resort, provide that capital to spur the economy and allow the economy to grow. The problem is the Federal Reserve is the problem. And so what happens is you're going to keep seeing this cycle until that inflation gets under control. And Tom will talk about the real priority that the Federal Reserve has is inflation over employment at this point in time. And so this is the trend and the cycle that we're seeing in the market. There are risks to the outlook, upside and downside. We're going to start by talking about the upside risks, because although we do see a downward trend here, there are upside risks to that. So these are the ones consumers still want to spend on big ticket items. You have business to business that is still holding up relatively well, and you do have some signs that inflation is peaking. So beginning with the first one, this is the big three: baby on the left, new home in the middle, and new vehicle on the right. The dark blue line is where the survey is today. The light blue line is where survey was last year. And what you can see is expectations for new babies, and this is just a survey that Bank of America does, is at very elevated levels. People still want to buy homes. So there's a desire in the economy to spend. Right now, they just don't have the money, but necessity is the mother of invention. So that gives us a cause for optimism over the medium term, and certainly over the longer term. Second piece is construction is still strong at the moment. We talked about backlog and new orders potentially slowing a bit, but right now design contracts still coming in growth mode, and that's good news. And in architecture and engineering services, there continues to be hiring that's going on in those spaces, even while job positions like marketing are coming down just a bit. And then the final reason for optimism here is inflation may be peaking. So the dark orange line with the axis on the left shows that the Bloomberg Commodity Index, which tracks oil, copper, aluminum, those type of products, raw materials, that's fallen from 167 to 140 over the last couple of weeks. It's still early days in that, but we continue to see oil declines even today. And then the Baltic Dry Index, which measures the cost to transport bulk dry goods like fertilizers across and coal across the sea, that's beginning to decline as well. So that's a good sign on the raw material side. And then if you look at the core inflation, this is the Cleveland Fed's estimate of where inflation is, and it's actually been fairly accurate over time. They're at about 8.6% right now in terms of a headline. We've actually seen core inflation begin to roll over since March. Not a whole lot, down from 6.6% to about 5.8%, but we're beginning to see some topping in that, even while food and energy prices continue to keep the headline consumer price inflation elevated. But there is a positive in that we're starting to see some moderation in those inflation rates on the core side. And for those of you in transportation, we do see transportation prices falling. This is the Logistics Manager Index, and I just lifted that chart directly from that report. But we're seeing those prices continue to grow on a year-over-year basis, but as you can see, they're falling relatively quickly. That's the good news. The bad news is there are still downside risks even to that outlook that we laid out. And the first one is Europe. This chart gives you an idea of the sector diversification between Europe and the United States. Europe is a lot more focused on financials and industrials. It's much more important to its economy, and they're much more important to the financial markets over there. Healthcare is important, but note that a lot of that is Switzerland, Novartis, Roche, and the UK, for example, AstraZeneca. So really it's dependent heavily on financials and industrials, which in turn, especially on the industrial side, are heavily dependent on natural gas. Natural gas is a feedstock for fertilizers, for chemicals, as well as a main ingredient as you try to produce utility power. And so the fact that natural gas prices in Europe have risen 5 to 6 times really impairs the industrial sector of its economy, to the extent that EDF has already been nationalized in France. That's a big utility there. And that Germany is preparing a $9.5 billion bailout for Uniper, which is one of their biggest utilities. They're burning through $35 million of cash a day because they're dependent on Russian natural gas, which is extremely expensive if they can get it. And it all feeds into this plan for them that they want to be at 80%. They want to fill their inventories to 80% by November. And the reason they're doing this is so that they can keep people warm in the wintertime. If they don't get to 80%, they're going to have to really hit some of the rationing, and which means some people will get gas or you'll have to take shorter showers. And what they've said is that they're going to prioritize residential over industrial, which is good. I mean, there's a humanitarian consequence that for sure, but if you really reduce the amount that an industry can have, you're hitting your economy, you're hitting BMW, you're hitting Mercedes, you're hitting BASF, which is the large chemicals company there. And the concern here is that Russia knows this and will start shutting off more of the gas and prevent them from getting to 80%. So really trying to ramp that up to 80%, that's critical as we look to Europe going forward. and it's difficult to see with the lighting, but the euro has fallen. It actually hit $1. It hit $1 on the nose this morning. That's the low. That's a 20-year low for them. Beyond that, you start going back to the Deutschmark. So it's a good time to visit Europe, but it's really tough situation for the European people, and this is a sum up of them relative to us. And Tom will talk a little bit about the second risk here.
So the second biggest downside risk in our mind is that there would be a central bank policy error. And I would argue that that error occurred roughly a year ago when we should have been raising rates when inflation hit 5%, but that's probably beside the point at this point. But what we've got here are 3 charts, and all of these are expectations that the Fed published early in the year, and then most recently, the left side, they expected the federal funds rate by the end of 2021 to be 0.9. Right now, we're on pace for 15 rate hikes for the year. So we'll be roughly at 3.5%. So you can see that they were way behind the 8 ball on how much they needed to raise rates as early as the beginning of this year. The second would be how much is the economy to grow? GDP in December 21, they said it's going to be 4%. Right now, they're estimating 1.7%. And I can tell you right now that we printed a negative number in first quarter. GDP now right now is negative 2%. So we're going to have extremely strong growth in the second half to even get to 0. And so I would argue that this number is still exceptionally low and unrealistic. And then the last one would be the inflation projection. So they expected that the overall year-over-year change in inflation would be 2.7% in December. They've raised that to 4.3%, but there hasn't been a month this year where we have not had an inflation print under 8%. And the expectation for the print later this week is 8.8%. So you'd essentially have to be at 0 or lower on inflation for the remainder of the year in order to hit that 4.3%. So what we have is a credibility conundrum, which is what we've called it really for the last year or so, which is the Fed is so far behind the 8 ball, there's so little, so too late, that we're in a situation where odds are the Fed is going to have to raise rates to the point where the economy goes into the toilet in order to basically rise from the ashes and get everything normalized. They're going to have to raise rates aggressively to get inflation down. And what suffers is in the middle is GDP, which is going to push us into recession. I would argue that we will be in a recession officially 2 quarters in a row of negative growth within the next GDP print. The next one would be the ECB. So the European Central Bank, basically Europe's version of the Fed. If the US economy is going to have to go in the toilet, the ECB is essentially going to put the European Union economy at the bottom of the septic tank. They are so far gone, they don't even know it yet. And what we see here is they basically said, they're going to stop their asset purchases, which is the APP, on July 1st, which they've just started to do, which is they're no longer buying bonds in order to keep rates low. And they're going to start raising their funds rate starting in July as well. And they're thinking they're going to do 50 basis points in September. But the issue with that is not all European economies are equal. You've got the northern half, the Germanys, the Frances that are exceptionally developed economies. They're doing very well. They have great demographics. The southern region, or the pigs as they call them, Portugal, Italy, Greece, and Spain, are terrible economies. They have shrinking populations. They have a lot of infrastructure problems. And as a result, what we saw is the moment they announced these measures, the rates on Portugal, Italy, they spiked. I mean, to levels we haven't seen in years, where the 10-year treasury, the 10-year Italian version of a treasury went up to like 4.5% in a day. I mean, it just shot through the roof. And what they're having to do now, and I believe it was the 17th of June, they had what they called an ad hoc meeting, which I would call an emergency meeting, where they had to reinstitute the asset purchase program, but specifically for the countries that were fragmenting. They have to actively buy Italian and Greek and Spanish bonds to keep those levels down, because if they don't, the debt levels in those countries and the interest expense in those countries is going to balloon out of control, and it's going to cause a lot of problems. And so as a firm, we have almost no, if any, exposure to Europe directly. And we think that, the European economy is going to be in a very, very tight spot. And if they continue to make policy mistakes, which I think at this point is almost impossible for them not to, that's going to have global ramifications. Europe is essentially the size of the US, 200-300 million people. They're big economies. And if they all go in the toilet at the same time, it's going to cause global ramifications. And that's a serious downside risk. So the central bankers, both here and abroad, have made a lot of mistakes. We're behind the 8 ball. And the question is, how badly are they going to drop the ball, and how badly are the economies going to suffer as a result?
And for what it's worth, on the European side, it's not unique that we have very little exposure there. I've worked as an advisor for 11 and a half years. Every year I go to an investment conference in which everyone gets on a podium and says, invest in Europe. It's really cheap. It's really cheap. It's really cheap. Guess what? Every year I'm glad I did it. Yeah. Valuations on stocks there are quite cheap. Why? Because, they're making materials and relatively simplistic goods. They have very little information technology. They don't have many companies there that would demand higher valuations. So we're positioned well as it relates to Europe. But again, we don't really make big market calls and say, hey, Europe's in trouble, let's get out of Europe. We've just not had that exposure.
Yeah, twice a year, Barron's puts out an article saying the European banks are the most cheap stock in the world. And twice a year we laugh because they stay that way. So something to chew on.
Sticking on the central bank theme, again, I don't envy the central bankers at all right now. I think they're in a very difficult position. The Bank of Japan has a policy where they're trying to keep no bond from yielding more than 0.25%, which means they keep having to buy bonds. The problem is you now have a bunch of hedge funds who are seeing interest rates elsewhere in the world, and they're betting against those bonds. And so the Bank of Japan just has to keep buying. And what are they buying it with? They're buying it with printed money, which is devaluing the yen. So just as we've seen the euro, I could put another chart about the yen, and it would have looked exactly the same. The yen is losing value versus the dollar, which incidentally, as the dollar strengthens, that actually helps our inflation picture here in the United States. But it's really tough for these countries internationally, and it really causes significant pain. So that's the second risk. The third risk is just we had to put it on more supply and demand issues. This is oil and gas, but there are a number of other industries that could be affected. China is actually looking to spur demand. They're looking to sell $220 billion of stimulus bonds for infrastructure development, which is good from the demand perspective, but a lot of that infrastructure is going to use raw materials that are already in short supply, which could cause more supply demand issues globally. So this is again something that we want to watch. Shifting gears a little bit to the market outlook, this is where we are in valuations. So the dotted line there is the median since 1990. It should be a dashed line, but it looks like a solid line. It's the median since 1954. I changed this to make it clearer, but I don't think that works so much. But you're seeing valuations come down, and they're coming down a little bit more toward historical averages. The big question we have right now is, okay, it's great if this current valuation regime is right, but if those earnings decline, then it might take the stocks along with it. So what we're looking to do, and what anyone who's managing money I would recommend them to do, is look at how well earnings can hold up. And so we really look at debt, a company's pricing power, to ability to maintain margin. And we also look at their revenue and their revenue volatility over time, because we want to avoid the big blowups where we think a stock is cheap and then they revise guidance down 75%, and all of a sudden the stock that we thought was cheap now looks expensive because they're not making any money. This is not foolproof though. We talked about Target, Nike's on this list, Deere's on this list, both of which have had tough times. And so the way you can mitigate that is diversification, which is even more important in environments like this. So even if you're doing the work and trying to improve that batting average, you still need to have a lineup that's sufficiently diversified. You can't rely on the same hitter time after time. On the fixed income side, Tom's going to talk a little bit about this and where we're seeing opportunities there.
So obviously it's been the worst year for bonds in almost 40 years. And so we've seen a lot of pain there. But I would buffer this whole conversation with the reason we buy individual bonds is because we know we're going to get them back at par, and we don't care what the price is in the period between the time we buy it and the time it comes back. So if the bond portfolio looks a little rough this year, just be happy to know that eventually all those bonds will mature at par, assuming they don't default, which is my job. So the big news this year is that credit spreads have widened. And what that means is, if you think of the credit scale, AAA, AA, all the way down to CCC, we've seen the spread between bonds that are AAA and less than AAA widens. So you get more money for taking on more credit risk over time. And the big one to really note is that high yield spreads have just absolutely blown out. And that looks like a really extreme chart. I mean, 600 basis points over a treasury, that's an exceptional yield. I was going to be really dramatic and change the slide here, but there you go. Or is it? So if we really are heading into a recession, you can look at 2009, you can look at 2020. What did high yield spreads do? They really exploded. And so, the first line I think would be like, hey, high yield spreads are really wide. They've been wider than they've been in 10 years. We should jump in on that. But if we are really heading into a situation where the Fed overshoots and where the economy really slows, high yield bonds are going to look exceptionally cheap at 20 basis points over spread over treasuries or even higher. And I think that's the point really where we would jump in. We do own some high yield names. Many of them we spent hours and hours and hours betting ahead of time. And if you can believe it, those bonds have outperformed this year when almost no bonds have performed well. So there are a few names that we really do like. But if we are dipping into high yield, we're going to have to be extremely careful. And for the time being, we are basically a stay away on high yield paper because we do expect those spreads to continue to widen because even though they are accelerating, they are not historically high. On top of that, I think it was 2 macros ago, we talked about how people were filing into leveraged loans, some of the very esoteric areas of the bond market searching for yield. And what we've seen is that has become a minefield for defaults. We've seen prices drop there significantly. And these are companies that aren't even creditworthy or large enough to get into the high yield space. So they've got to have these loans where you basically are doing LIBOR plus 900, LIBOR plus 1,000. So it's, oh man, great, I'm getting an 11% yield, but if you get 11% of nothing, you get nothing. And so that's an area that has really, really suffered. And there was a lot of pressure, a lot of sales calls. Hey, you got to get in this leveraged loan program. You got to get in on this stuff. Rising rates are going to be so good for this stuff. Obviously not. Mortgage backs, on the other hand, are something that we're definitely starting to take a look at. Those spreads are historically high. We haven't seen spreads this high with the exception of a couple weeks in 2020. And those are AAA bonds, especially if you're sticking to GSEs, which are government sponsors, NCs, the Ginnie Maes, the Freddie Macs of the world that are explicitly or implicitly backed by the US government. It's not a move we've made just yet. I think there's still some opportunity for pain in the mortgage-backed security space, particularly if we get a very hot CPI print this week. I think that's a position where we would start to move in there because there are some benefits should the Fed have to start cutting next year, where mortgage-backed securities will actually outperform and likely fall significantly in that scenario. And so that's an area that, if the bond market is a game of whack-a-mole right now, mortgage-backed securities have popped up, and we're taking a look at potentially whacking that mole. Muni bonds are a similar story. These are ultra high quality bonds, and they've sold off for reasons that are inexplicable to me because credit quality is higher than it's ever been. There was so much money pumped into local governments as a result of COVID that balance sheets are fat. Not only that, but most muni bonds are paid for by ad valorem taxes, which are a direct function of the price of your house. And so if your home prices are elevated, then tax revenues are way up, and that means more money to pay off these bonds. Following that, they're the most scarce piece of the market there is. Issuance is always low. There's always new laws coming in to prevent tax-free bonds. And right now we can get them historically cheap. And so that's the other piece of the whack-a-mole game where we're trying aggressively to move into muni bonds at levels we have not seen in quite some time. Even though all through the pandemic, they were also relatively cheap, that relative value has increased and their credit quality and scarcity has also increased. And then finally, we have to talk about the fact that the yield curve is inverted. Some of the people in this room were in the presentation back in 2019 when we first talked about yield curve inverting in sort of the early spring of 2019. And does that mean we're headed into a recession? And some would argue that COVID was a recession, and that may have been an indicator ahead of time, but I think those were probably more anecdotal than anything. But we have had 3 consecutive yield curve inversions, meaning that you can get paid more yield for a 2-year bond versus a 10-year bond. And this chart is even not as exaggerated. It is right now, as of today, we hit the lowest inversion, the lowest relationship between the 2 and the 10-year treasury since 2007 after Lehman collapsed. And so we have a very unusual shape of the yield curve. It is a harbinger, some would say, of recession. I would argue that we're already in the recession, so this could be completely irrelevant because we're already there. But it does create an opportunity where we can, if you think of the yield curve 2 years ago, there was zero value 2 to 5 years, and then some value 5 to 10, and then you got a little bit for going out to 30. And so the way bond portfolios had to be structured, because there's no value here, we had to start 5 years out and start building a ladder. Well, now we're 5 years later, we can start filling in the spots where we weren't able to buy those bonds in 2023 or 2024, and we're getting them at historically low levels. So we can really fill in those ladders and build the yield, build the credit quality without having to take a lot of interest rate risk, which is going to be paramount with the Fed continuing to hike rates potentially 8 more times this year.
So to sum up on the investment landscape side, that's the same map that we used earlier in the presentation. And so that's the base case of kind of where we are and where we're going. And again, inflation is the critical component there. We'd love to see inflation turn down. We'd love to see that confidence improve, and that could kind of snap us out of this. But then you also have, on the flip side, you do have those downside risks. We talked a lot about Europe. We talked a lot about central banks and just that unenviable position they are in. And then we had to talk a little bit about supply and demand, just in case those issues recur, because we're not totally out of the woods on that. Andrew,
yeah, I'll wrap us up here. So bring it home. Yeah. What's this mean for you guys? The first thing is on the personal side. You know, for us, our best clients are the client relationships in which they're handling their side of the equation and following advice that we offer when asked. And we're handling the investment side. So we're going to talk about the investment side in a moment. But on the personal side, you know, arguably for the first time since 07, 08, we're really going to preach to you on the importance of having cash. We're selling against ourselves when we say that. Everybody in here that's a client knows we get paid based on the amount of money we manage. This is a period in which it makes a lot of sense, if you have insufficient cash needs, to start building that balance. Now, if you're sitting here and you're saying, hey, my reserve fund is 6 months, I'm very comfortable with that. I also have excess cash. I do think there are opportunities, but this is a time to be building cash. And I don't think you need to necessarily negotiate that opportunity relative to your investment portfolio. I think you need to negotiate that opportunity relative to potentially making a large purchase. Is this a good time to buy a new car when you don't have to? No. Is it a good time to be, you know, speculating on some wild Bitcoin, crypto, whatever? I don't think so. I've said that as long as crypto's been around. So, you know, this year I look good for the first time, but it's a period in which you need to be disciplined. You need to be mindful of your debt situation. You need to be mindful of that. Historically, really for the last 5 years, we've had consistent conversations with folks when interest rates were exceedingly low. There was no reason to think jobs and incomes could be in jeopardy, where we've not said take on unnecessary debt, but we have been very comfortable with debt on a personal balance sheet, especially with young people. This is not necessarily that time. So you need to be thinking about that and thinking about what your next move is. On the equity side, our goal right now for every client we have is twofold. First and foremost, we want to stay disciplined to those investment policy statements that we've built with every client. I hear people's eyes roll over the phone when I talk with them about this, and they say, "What are we doing?" And I say, "We're doing what we said we would do. We said we were going to keep you at 67% equity, and we're keeping you at 67% equity." I hear the frustration there. I understand that. The market changes quickly, and as we say over and over and over again, the market is not the economy. If you draw it out over a 100-year period, it looks like those things move in concert. They do not. I think a lot of the damage that we anticipate moving forward economically is already priced into the market. That does not, however, mean that I'm calling a bottom or saying it's done. But the market tends to price these things in much quicker, both to the downside and to the upside. And so when we talk about staying disciplined, the reason is we built those investment policy statements and those asset allocation targets knowing the potential of a year like we're experiencing right now in 2022 is very much in the realm of possibilities. Don't get me wrong, we don't want more years like 2022, But in the grand scheme of things, this is built into those models. When people think of equity returns, they tend to think of, 8% a year, or 7% a year, 10% a year. Pick your number, pick your index, pick your time period. What's lost in that is there's down years. What's lost in that is there's years that are significantly higher than that. When we build these targets, we're baking into that cake the idea that there will be down years, there will be significantly higher up years. We want to manage through that. And so when we talk about equities, we're staying locked in at where we are. The only nuance I would say that's different to what we're doing right now is we're putting an even greater emphasis on diversification. If you're a client and you've been a client for some years, you know we are not running a 10, 12, 15 stock portfolio. We own 30, 40, 50 names. This is a period in which we're ideally owning on the higher end of that range. We want to diversify. If you've been a client for a while, you know that we really like large blue chip dividend paying U.S. companies with good cash flows and manageable debt loads and balance sheets. We're putting an even greater emphasis on that. It's not a new emphasis, but it's a greater emphasis. So on the equity side, what we are looking to do is buy companies, one, that will make it through this period, which could be prolonged, and two, that we want to buy companies we will look back at and say, man, I can't believe we bought this so cheap. About once a month, we bring on a new client and they send over their portfolio and we look at it and we say, how on earth is their cost basis for this company so low? How did they buy this so cheap? And you look at it, and it's like, well, they bought it in February of 2009 and the bottom was March of 2009. We want to own those companies. We went through a miniature version of this in December of 2018. We had a great year as a firm on equity performance in 2019. Not to pat ourselves on the back, but it was all me. We had a great year of performance in 2019, and our best performing stocks were stocks that we bought in December of 2018, where we just said, oh my gosh, I cannot believe Microsoft is this cheap. We had a stock market that was down 12% in a month. It created opportunities. So we want to buy companies that are going to make it through, and companies that we're going to look back in 18 months, 24 months, whatever, and say, man, that was really, really cheap. On the fixed income side, the biggest thing we're paying attention to is staying agile. As Tom pointed out, and as I've said to a lot of clients, even some people in this room, we don't really care about intra-year performance on fixed income. If we do our job right, when we buy a bond, that day, when it settles, we know how much money we're going to make on that bond. We want to stay agile and consistently buy the best opportunity that presents itself, whether it's a muni bond, which is the core of what we do, whether it's a one-off high-yield corporate bond that we feel very, very comfortable with, whether it's a mortgage-backed security, something we haven't dipped our toe into the water yet, but that we're looking at. We want to make sure that what we're buying at that moment presents the best possible value. Thereafter, all we're really concerned with is this entity, whether it's a municipality, a corporation, a bundle of mortgages, is it going to stay solvent? And if we do our legwork on the front end, that shouldn't be an issue. So for you guys, the biggest thing I'm preaching to you is what we're preaching to ourselves. That's stay disciplined. If you have a major purchase that's not a necessity at this moment, especially something where you just say, I'd like to have that, maybe hit the brakes there. If you're buying something that's going to have unbelievable utility to it, and it's potentially a good investment, and it's going to appreciate in value, let's talk about it and let's have that conversation. Melissa Visible is here. She runs our financial planning. She is an unbelievable resource. I cannot sing Melissa's praises enough. Some of you in this room have worked with her. I think a lot of people, because historically we've been so investment focused, say, well, that sounds like really touchy-feely. I don't want to get into this. I don't want to share all these things. I certainly don't want to bring my spouse to a meeting and talk about money. I cannot encourage you enough to work with Melissa. Don Scola, Jonathan McKay are here on the accounting side. If you need help on that, talk to them. There's unique challenges if you're a business owner in this current environment that we have not necessarily experienced in the recent past. So talk to them. I'm grateful for all of you as clients. I appreciate your patience. I understand that it sounds like we're just repeating ourselves when we say we're doing the same thing. We're staying disciplined. We're prioritizing what's important in this environment. I understand that and I hear that. I also am not going to lie to you and tell you that we're doing something totally different. I'm not going to sit here and say, you know what? We're going to totally switch things up because the market's down 18%. Because the reality is the market being down 18% has always been in the realm of possibility. So I appreciate your patience. I understand that we sound like broken records sometimes. That's not the intention, but change happens quickly. And rather than fight that change, we're very comfortable saying we've accounted for that change. CEO confidence went from an all-time high in January to a pretty close to a low 6 months later. Did we know that was going to happen? Raise your hand if you did. We didn't. If y'all did, y'all should have talked louder to us. But we recognize that. And because of that, we're not comfortable saying, hey, let's just totally change things. We're very comfortable saying this is an ugly year. And we recognize that. But we've accounted for years like this. And we're going to march through it and we're going to prevail. We appreciate your patience. We do not take your trust for granted. We labor over these things. If at any point you think you're losing more sleep over this stuff than we are, you need to call me immediately. And I guarantee you, you might be losing more sleep than me, but you're not losing more sleep than this guy. And you're probably not losing more sleep than Tom because he's got a young child. So with that, Q&A. Who's got anything?
The housing market. I know historically speaking, notorious in a recessionary period, that housing markets actually appreciated, actually have depreciated. Minus middle wage. Now you had all these like unethical loan products, these federal obligations from Wall Street that kind of caused that. But now there's so much equity in people's homes that are on fixed products and demand's still high.
Yep.
I mean, there's no reason to believe see any kind of like housing prices. And if we were, you saying we may be in recession, and you saying that
We're definitely in a recession.
yeah, okay, so
We are in a recession. You hear nothing else. We're the first financial media experts to say we're in a recession. We've been saying it for 2 months.
Well, what does your data say? Just go by itself, mathematics. No emotions, not stuff here from what people experience don't need. But
Yeah.
what are y'all seeing?
Yeah, so what we're seeing, Mario, is right now, homes on average are still selling above list price. They're about 102% of list price on average. We're starting to see price cuts. So typically you see about 4% of homes on the market have had a price cut. Last year, that was 2%. No one was cutting prices on the homes. Right now it's 6%, and that's increased significantly. So what you're seeing right now in housing is this balance where sellers don't really want to admit that their home might not be worth just as much as the estimate said it was. It might be worth more than they paid for it, but not as much as that estimate. And so we need to find an equilibrium in that, which is part of the reason why homes are moving a little bit slower. At the same time, I would agree with you. I think that there is such a strong interest in owning homes. We have a chart, I think it's like slide 25 maybe. It definitely isn't, but it's, oh, there it is, the triple blue.
Boom.
Yeah, I mean, the chart in the middle there is, the dark blue line is, in the next 12 months, do you plan to buy a home, an apartment, condo? And the expectations that, and they're surveying regular people here. A lot of people want to do that. In fact, more people than any time this year, more people than this time last year. So the intent is there. The question is, where do mortgage rates kind of settle out? And where does that inflation piece settle out? But that desire is there. So I would agree with you, Mario, that this is probably not like a 2008 scenario. It's more typical of, I don't want to call it a garden variety recession because that feels like we're glossing over something that's really meaningful. But it's more your typical recession.
Yeah, and I would add a couple things. Even on the big three, raise your hand if you've had a child without thinking about the economic ramifications. That's on the left. On the far right, one of the most mind-blowing things to me is when you see somebody driving around in a car that's worth 50% of what their home is worth. And you see that consistently. We've got a client that owns a couple automobile dealerships, and he said the number one financial factor, this was 3 years ago. This has nothing to do with where we are right now. The number one financial factor that people weigh when they decide if they want to buy this car or not is, what is my monthly payment? Because of that, we have gone from a period in which the normal car loan was 36 months, drifted to 48. Now we're looking at 84. People are buying cars on 7-year loans. Why? Because, well, I'm okay paying $500 a month for a car. That's not a real sophisticated way of thinking about a major purchase. I would argue that most of the people thinking about buying a home, and some of this is anecdotal, when a young client or a client's child calls us about maybe thinking about buying a home, 7 times out of 10, they've already gotten pre-approved. They already know what their budget is. They already know what area they're looking for. They're putting real thought in. So there is, I would argue, a meaningful demand despite the financial backdrop on houses that may not exist on automobiles and certainly doesn't exist on the child front. So that's one thing. Second thing, Mario, you're smart to not associate this with 08 and 09. A big challenge we face, clients associate financial hardship with whatever the last financial trauma they had was. This is very different than what we had in 08. That's part of why we're comfortable talking about mortgage-backed securities. That was a no-no. If you've read The Big Short, if you've watched the movie, anything like that, you probably thought, whoa, why on earth would Narwhal think about getting into something like this? It's a totally different credit backdrop. But most people associate, when they hear mortgage-backed securities, they think of the glut of people with practically no income having 3 homes in 2005, 6, 7, 8. So most people associate it with that. I argued the point earlier that the single reason that we have not had a sharper recession was that people were sitting on savings. The second biggest factor is that we were so massively underbuilt for a decade plus on homes. There is not an oversupply on homes. We have got to get to that equilibrium that's been touched on. Getting there, in my view, I think in yours, does not mean we need 30% price decreases on homes. It means we stop going up 18% year over year. It means home prices get back to normal. Over a 100-year period, typically home prices increase by about 1% more than inflation. We tell people all the time, if you're thinking about buying a home, make a wise financial decision. But if it's a home you're going to live in, that is not an investment. Historically speaking, you'll do barely better than inflation. Make a good decision on what your monthly payment is going to be and how much equity you would like to slowly build there. We've been in a period in which no part of my decision when I bought a home in 2019 was, is this a good investment? And my home's worth close to twice what it was when I bought it. That's not normal, but that does not necessarily mean my home price needs to be cut in half. So I don't think we're due for that massive collapse. Any other questions?
Any, there's something in the chat. Zoom.
Yeah, I got a question again. Will the dollar be stronger than the euro when Fed has flooding? So that's my determining factor. If I'm going to get
I hope so. I hope the dollar's stronger than the pound when I win. Right now it's 119, but
I'm going to buy so much stuff.
no, but I mean, the scary thing is, you know, we talk about it, but there's real ramifications for people who are living there. And it's, you know, if we think that the economy is tougher today here, it's tougher in Europe, it's tougher in Japan. And so it's a tough environment out there for sure.
Yeah, yes or no, Ben?
I am thinking that the euro may try to bounce. It's depreciated a lot. You don't see 20% declines in currencies very often. You didn't see the same type of decline even when Greece was talking about not being able to pay its bills. So I don't think it will. It might go down a little bit below $1, but not a whole lot.
Yeah, you were talking, Ben, you mentioned that companies are having a hard time raising capital in the equities markets.
Yeah.
And this, I seem to notice like middle of last year towards the end, there seemed to be this really big demand for institutional investors to invest in commercial real estate, particularly industrial. You think those two things are correlated in any way? Or?
I think there's yes. I think they're correlated. I think that there's a lot of capital, a lot of liquidity in the system, a lot of liquidity that wanted to invest in the new IPO, and there was a lot of liquidity that wanted to invest in commercial industrial real estate. The warehousing was huge. We actually had a conversation with a gentleman yesterday where we talked a lot about that. And on the warehouse side, kind of the boxes, I would say that's probably not the place to be, but there are opportunities in things like data center, which are continuing to grow and support cloud usage and things like that.
Yeah, we were talking with the CFO and president and chairman of a pretty sizable general contractor that really for the last couple of years has built a massive backlog building warehousing. They're seeing that, hey, this is overcrowded. Now, on the other side, they're seeing massive demand. I mean, this is a company with $1 billion plus backlog. They're seeing massive demand for actual manufacturing facilities. So that is still warm. And their view on it at a high level is it got to a point where there was no margin to be had building a warehouse. But if we can build something slightly more specialized, there's a ton of opportunity. And part of that is driven by there's so much money pouring into warehousing. So more traditional industrial space, which frankly, up until relatively recently, you would have associated industrial real estate with manufacturing. Whereas recently, with the rise of Amazon and so many others, you've started associating it more with storage and shipment. They're seeing a pretty pronounced gap in a still very real need on the actual manufacturing side.
Yeah, so you're talking like life sciences, reefer,
Automobiles.
Yeah, that kind of stuff. Like Rivian is building a big manufacturing plant here.
Yeah, a lot of those industrial investments, you know, if you're building a $5 billion plant to build more vehicles, you're not just gonna pull away from that huge investment that you spent 3 years planning.
And you've announced you're publicly traded. There's a ton of news on this. Guess what's going to happen if you're the CEO, CFO, C-level executive that owns a whole lot of stock of that company, and you come out and say, actually, we're not going to build that $5 billion plant. Guess what happens to your net worth? It just plummets. So it may be solely out of stubbornness, but they're going to push forward with that.
How long, if we're not supposed to compare it to 2008 where it dived down and then it stayed flat for 5 or 6 years, how long is this going to last?
Gun to my head, we're going to have 6 months of negative GDP. It's never going to be as deep as what we saw in 08. It's going to be much more painful, though, than people realize now. There's this entire cross-section of the economy of, is anybody in here 25 years old? There's this whole cross-section of people like Hicks and Jason and Michael Bell that are 25 that walked into jobs where they never had to go to an office. They are a such and such analyst category 3 for a massive company. They do very little. They've developed a lot of hobbies. They've made 6 figures. That cross section, yeah. So not those guys, but I think there's a massive cross section of the economy of people like that who have not really experienced this, who were 10 years old when '08 happened that are in for a real world of hurt, because there's a lot of fat at the corporate level. I mean, it's like the Tesla story. At first, Musk said, hey, we're going to lay off X% of our workforce. Then he had to come back. You got a little pressure. It was like, no, it's going to be salaried people. There's a whole lot of people that aren't actually doing anything that's truly accretive to the company. But the company has been able to borrow money cheaply. They've been able to pay people for a while quite cheaply. I mean, we've seen massive expansion in wages, but from 2008, the real median wages kind of peaked in early 2008, and we didn't clear that level until 2018 for 10 years. So I don't think we're going to have a period where we draw down that deeply. It's not going to stay flatline low, but my gut is we're probably looking at 18 months or so of things are pretty bad, and people that thought they would never be impacted are.
I would agree with Andrew. The other thing I'd add is that I think on the kind of going back to the personal financial decision side, I think this is a critical time where if you're looking for a job or looking for that first job, don't just look at the one that pays the most. Look at the one that will keep you employed. And you know, what's the one that manages things conservatively? I mean, you look at Costco. They own all their real estate outright. They provide an essential product, or they sell essential products. They have a huge cash buffer. They don't have any debt. That's the type of company you might want to work for, rather than a OneTrust startup company or a technology company where you're getting a big pay package, but a lot of that's in stock-based compensation that's going down, and you don't know if the product, like a Rivian product, will really be built in massive numbers. So I think that on the personal financial side, I think that's a decision that a lot of young people haven't really had to think about, but that's another thing that they should.
And even on the services side, like we're a service business, Narwhal. We operate pretty cleanly. Matt pays everybody $12 an hour.
Except on holidays.
Yeah. Now that Matt's gone, we can tell. Oh no, he's there.
You get free drinks.
Yeah, we get free drink. He pays us in cocktails. No. But we operate pretty responsibly. And what's wild to me, like we're a service business where like we don't have a lot of capital expenditure. So if we make a hire, we need to get a computer, and that's about it, right? I'm in a study group with 7 other people like me that are kind of running their firms. Every one of those firms is bigger than ours. Most of them are laying off employees. We're actually hiring, like actively hiring. I hope to someday not be hiring. That would be awesome. But the point being, could you take a job with the firm in Boston and make more money than you would make with us? Absolutely, no doubt about it. If you have both offers and all you care about is what you're going to make right now, go there. Will you have that job in a year? I don't know. And so I think the service industry is also going to be impacted. We saw it on the marketing side. Those tend to be relatively low-cost businesses. The money is going into the personnel. And when people stop paying for that, they don't need the people. And so those are areas that I think are particularly ripe for concern. We mentioned retail, we mentioned dining out, those things. Those areas are going to have some challenges. Probably not on the dining, especially side, probably not as bad as what we saw in 2020, but there is going to be a reduction in people that are going out to eat.
To get another round of drinks for the people who work here.
So I mean, 6 months to a year. So like with Matthew,
18 months.
18.
6 quarters. 6 quarters.
Oh, okay.
Yeah, I know you.
I meant 6 quarters if I said 6. We're
Theoretically,
already 6 months in.
Yeah.
Free drinks.
Yeah.
Quarters, months, so that's from today.
I think from the startup.
I mean, right now, the
We're-
expectation is the first rate cut will come in March of 2023, based on futures. So people expect that the Fed is going to overshoot, crash the economy, and have to cut rates
I
again.
think middle of next year we're climbing up.
So the first rate cut is right now based on futures in March 2020. So the expectation is they're going to ramp it up the economy was slow significantly, and then it went farther out than that. It moved up 2 meetings within the last few days. Because it was initially May, is what people were indicating. Just in the last few days, it's accelerated forward. So they already think that the Fed has made a mistake.
If you're looking for a corollary, I think the most clear corollary, and I would definitely caution against reading too much into this, but the most clear corollary on recent memory would be 2000, 2002 in terms of the length and the type of bubbles.
So we're in a recession period now. Let's say that, they look at that as 4 years old and that's a good job. Maybe it's not thinking super stable. Let's say they've already not essential job. But it'd be smart for them to actually just go look for a new job while they're still employed on stocks. I mean, it seems like there's a lot of uncertainty in the future.
I mean, I can tell you-
Obviously, we keep raising rates.
On the OneTrust thing, so what I did the day after the big layoff on OneTrust, is I searched the company name and sorted by posts on LinkedIn, and you would be shocked by how many people were like, I was supposed to start my job tomorrow at OneTrust. I was really looking forward to it, and they called me and said, this job is no longer on the table. So I would say proceed with caution, especially if it's an industry where it's possible that they may rescind the offer. That would be my biggest concern, is that you go take another job, you leave a job you have, and suddenly that job's not there anymore.
The other thing is the practicalities of it. A lot of times the easiest people to let go are the first people brought in, or the most recent people brought in. So I would take that into consideration as well. But overall, I think that, if you're doing a good job and you're bringing value, then, and if you're bringing value to a company or not, then I think you're probably in a good spot. Because companies want people who can bring value at the end of the day.
And companies value loyalty. I mean, that's the other side. If you're paid in any way on commission, et cetera, if you can grind it out over the next 18 months and you stick it out, you're going to be significantly valued by your employer. Because if you're doing everything you can to be profitable for that company, and you're doing everything you can to bring money to that bottom line, but there's circumstances just beyond your control, companies realize that. And they value that, hey, this guy or girl stuck it out in a tough period. That's going to put you in a good position coming out.
We're talking a lot about interest rate hikes, but what's going on in the background? That's
So they really haven't ramped up yet. They're about to start doing the full gamut. And I think that's really the reason why we haven't immediately jumped into mortgage backs, is because they haven't even started selling the full, quota of mortgage backs. So I think there's going to be a lot of pressure there. Also, the CPI print. So when the last CPI print came out, mortgage-backed securities went no bid that day. Nobody wanted to buy them and nobody wanted to sell them because there's so much uncertainty around that. And so I think that's really what people are looking at, is the lack of liquidity that comes from them being an active seller instead of an active buyer is going to cause a lot of unintended consequences that I think we haven't really seen yet. And so it's kind of still a question mark. When they start actively selling, the full salvo of treasuries and mortgage-backed securities, things should get pretty wonky pretty quick. And I mean, March 2020 is a great example.
Yeah.
When there was no liquidity in the market, I mean, stuff just fell. I mean, the bond market is so fragmented. The price is whatever somebody's willing to pay for it. And when there aren't that many buyers, I mean, March 2020, I would put stupid numbers on bonds. Like a bond traded $120 the day before, I would bid $95 and we would win that bond.
If you're a client, we're not real good at sales. We're not pushy. March 2020, we were buying bonds that we didn't have holders for. And I was picking up the phone, calling people and being like, hey, if you can open an account now, we can give you this bond that was worth 30% more yesterday. It's probably going to be worth 30% more in 2 weeks. And we were sitting on bonds and trying to open accounts, get them funded as quickly as possible so that we could place the bond stuff.
Yeah. So to answer your question, the lack of liquidity coming from them selling the full salvo, I think, is the big question. What's that going to look like? How wide are bid-ask spreads going to get on corporates? How wide are they going to get mortgage backs? We still kind of haven't seen that. And that's so we're still kind of like, this is a great opportunity. You can get twice the yield of a 30-year treasury on a 30-year mortgage back and know the Fed's going to have to cut rates which will accelerate that back to you. But the question is, how volatile is it going to be between now and the top of the mortgage-backed security market? So it's kind of a no answer, but the answer is it's really, we don't know because it's been so long since it's been no liquidity in the bond market. So
On a sustainable level.
honestly, yeah, for like where it's like we're not going to come in and be the buyer flash resort like March 2020, where we step in and start buying ETFs and corporates and whatever we want. Like they're basically saying we're a net seller, you guys are on your own, and we're headed into a recession. So
They've done analysis on how much does a rate increase or a rate cut equal in terms of quantitative easing or quantitative tightening. Problem is, it doesn't mean a whole lot. So in theory, yes, quantitative tightening will mean you don't have to raise rates as high, but without knowing what that kind of intangible number is, it doesn't mean a lot to say quantitative tightening of $100 billion is equivalent to a 50 basis.
Then do central banks do that? Yeah.
Yes.
so clearly they can't put their finger on anything. They don't know where we are.
I mean, they're terrible. I think this is personal opinion. Don't hold me to this. Everyone that works for a central bank is an academic that has never actually managed anyone's money. So when the academic evidence says you have no excuse not to do this, that is when they act. At that point, it's too late. And that's my view on, you know, we've talked before about Jay Powell, like how he just wanted to get reelected, therefore he didn't raise rates. That's part of it. But then part of it is, I mean, they are still, you know, I mean, within the last couple of weeks, there's no signs of weakening in the economy.
Yeah, they're doing the.
There was an awesome quote about car repossessions in Barron's magazine from a guy named Lucky Lopez. And I'm like starting a campaign to get that guy to, yeah, like he's coming on our podcast, no big deal. Lucky Lopez, we got him. We got Lucky. Lucky Lopez is going to come on podcast, but his quote in Barron's was, when people talk about no slowdown in the economy, they're obviously not business owners. There's no one on the Fed that thinks that way.
I mean,
They say, hey, I have backward looking data that finally says we're slowing down, therefore let's change our policy. And there's nobody at the European Central Bank that way. I mean, it's just all these professors and people that have never really had any real consequence for a decision they've made. And that's why, I mean, it sounds oversimplified, but it's like they are 100% reactionary. But not only reactionary, they are reactionary through the lens of, am I 100% sure that all the backward data I'm looking at is accurate and pointing to the same thing? They're not predicting anything. Yeah, Lucky Lopez, we got him. He's gonna do a long form.
It's actually,
Yeah, he's a wild guy. He's got a lot of vast experience in the automobile industry. He's got hundreds of thousands of followers on YouTube. And I was like, I have nothing to offer you, Lucky, but we've got like 10 people that listen to the podcast. and he was like, I'm in.
and 9 of them are here.
With demand down, do you think supply is actually going to catch up, or do you think we're in this boat for the long haul?
That's the biggest concern. I mean, they're so, and that's the big issue. You know,
What's the biggest concern?
For me, the biggest concern is supply.
If demand is going down with this.
And in theory, raising rates hurts supply. So there is a big leap of faith being taken that supply chains will not be interrupted again. Obviously, even earlier this year, we were having to navigate through a complete shutdown in China. And so that is the concern that's not only hard to quantify, but there's a lot of things here where, as we just did, we can point to the Fed and be like, these dummies didn't do the right thing at the right time. Supply chain, they can't really control. I'm optimistic that the supply chain is improving and will continue to improve. But I also think there will be some bumps in that. And I think the hardest thing that most people grapple with on the supply chain is the lagging impact of it. People think hey, this factory was closed for 3 weeks. Then they reopened, therefore we're 3 weeks behind. That's just not how it works because they're working on multiple things at the same time. It's a longer lag to ramp up to full capacity than the time off spent. And we're seeing that in the auto space. I mean, most people that are closely related to the automobile trade will tell you, like, we're not going to see normalized supply until late 2024 or 2025. So we're not talking this year, we're not talking next year. We're talking the year after next, later in the year, or possibly the following spring. And so that's the issue that's going to be a challenge. Now, there's also a degree to which supply chain issues, the other thing that's hard to quantify is the degree to which just the difficulty, whether it's pricing or wait times, impacts demand. You know, if I want to buy a new F-150, but to do that, I'm going to have to spend $10,000 more than I think I should, and I'm going to have to wait 9 months. Guess what? Demand just dropped by one person. Because I'm not going to do both of those things. Some people may not do one of those things. And so there will be kind of this accelerated, I think, meeting of even as supply falls, the pricing and the lag times will further push demand to where it should be. So it's a little bit of a both sides of the equation thing there, but it's hard to really put a number on it or quantify it. But I think it's generally trending in the right direction on supply.
And I'd say, Frank, I think that's the critical issue. I mean, if we can get supply and demand more in balance, and we can start getting inflation down, that is the critical piece, the ingredient for this economy. So, I mean, that's why we had it as a potential upside risk, because if we can solve that problem to an extent, we have some runway. We still have some good savings in the economy, both on the corporate and the personal side. The problem is that slope. We're losing runway, and we're losing runway every month. So if we can start getting that down to, you know, wishes now, but if we can get that down 6, 5, 4%, moving in the right direction, we can stave off certainly the worst outcomes here and potentially rise out of it sooner rather.
Anything else? All right, cool. We'll wrap it up there. When we got here, it was 78 degrees in here. My goal was to have us talk long enough till we were running a fever. It's only 85, so we didn't make it. We appreciate y'all's flexibility with the temperature, the time. If you have questions, come see us. Sam Frost, the portfolio manager, is also here. Jason Sieve, an investment analyst. Accounting team's here. Melissa's here. If you have questions, come see the appropriate party. We'll be happy to talk with you.
6:30.
Yeah, we're gonna start limbering up here soon. So.
I know this starts.
And why is so many of the car purchase bad things?
I saw Don buy a new truck and I was like, what a moron.
I said it before I ever saw the truck.